Hello, this is Jeff Kleintop, Chief Market Strategist for LPL Financial. I want to thank Sandeep for the opportunity to speak to you all today and share some of our thinking on the outlook for the markets. You know, there's an old adage that the markets climb a wall of worry. And the wall of worry that the markets have been climbing since March remains in place, with individuals remaining somewhat pessimistic, as can be seen in surveys of investor and consumer confidence, but also in all the amount of cash on the sidelines. Consensus expectations are also not very optimistic among professionals. Economists expect only about 2% growth next year in the economy. That's well below average for a year that follows recession. I mean, history suggests the rebound after a recession is usually 6 to 9% in GDP. And stock market analysts are also looking for only a typical post-recession 25% profit rebound for S&P 500 companies, despite the far deeper than normal trough in profits during the recession. By year-end 2010, the forecast rebound would bring the S&P profits really only back to where they were in 2005, which is about 20% below that peak back in the mid-2007. So we think this is a very reasonable expectation for earnings growth in 2010, given the drivers that have pushed margins to really wide levels on really aggressive cost cutting over the past year. So we think that's pretty reasonable. But with stocks now up 60% from the March 9th low, the big market gains are likely behind us as the economy and the markets may begin to face some challenges in 2010. Now, all of the tailwinds that we've seen over the course of this last year, including the Fed pushing interest rates down to zero, the $125 trillion in mortgage debt that the Fed is in the process of buying right now, and that $787 billion fiscal stimulus package passed back in February of this year, all of those tailwinds are going to begin to fade by early next year and even begin to maybe turn into some headwinds that could generate a renewed slowdown in the economy and potentially some losses for investors as the Fed hikes interest rates, as the Fed begins to sell some of those bonds it's purchased and widen credit spreads, and as that spending from the government begins to fade a little bit. So while we see some gains in the months and quarters ahead, volatility is here to stay as we look out to 2010. In fact, the outlook for 2010 might seem a little bit familiar. Some forecasters are looking all the way back to the 1930s or other time periods to find a comparison to the environment we might encounter in 2010. But we find a more recent comparison to be compelling. We think that 2004 could provide a good guide to what we're likely to see in 2010. The idea that 2010 could look something like 2004 really isn't as far-fetched as it might seem. After all, 2009 looked a lot like 2003. First of all, the S&P 500 started both years, 2003 and 2009, at about 900 and ended the year around 1100 as the year wore on. That's pretty much what we've seen this year. And the stock market bottomed in both years in March after a bursting of a bubble in the financial markets. Then it was tech, this time it was housing. And key economic barometers have looked the same too. We saw the supply management's index, the purchasing managers index, rebound around the beginning of the year, got over that critical 50 level. Same thing then as we're seeing now. And then the dollar fell and commodity prices rose. Same thing that's happened this year. So the years looked very similar in terms of their charts. In fact, the years even sounded similar. Back in this year, in 2009, the best-selling album is actually from back in 2003. It's Michael Jackson's Number Ones, a compilation that was put together back in 2003. So it doesn't just look the same, it even sounds the same. But just as 2009 echoed 2003, 2010 might echo 2004 in a number of ways. First of all, earnings growth for S&P 500 companies is expected to rebound pretty sharply. That 25% rebound that I had talked about was the same rebound that we saw in 2004 from 2003's earnings. In addition, the Federal Reserve is likely to hike interest rates in 2004. That's something that we saw something that we're likely to see in 2010. In fact, it was the middle of 2004 when the Fed started to hike rates. We believe it'll be the middle of 2010 where the Fed starts to hike rates this time. So very similar in terms of the earnings backdrop, the Fed's backdrop. How about politics? You know, the last time we saw the Republicans gain seats in the House and the Senate, was in 2004. They picked up seats. This time they're likely to pick up seats again, given the backdrop of the seats that are up for grabs and sort of the changing political dynamic around, the president's party usually loses some seats in the midterm elections. And anyway, if the Republicans do gain some seats, that might change the current political dynamic and the filibuster-proof margins we're seeing in the Senate, which has created some uncertainty around the potential for sweeping legislative change. So that might change a bit next year. And then finally, I think we'll probably also see some other things that were similar to 2004. 2004, we saw the bond market post modest gains, low single-digit gains. I think that's something that we're likely to see in 2010. And the stock market was up 9% in 2004. That's something similar to what we might see, mid to high single-digit gains in 2004. I think we might see gains in the first half of the year that are trimmed a little bit in the second half of the year as we go from the tailwinds of stimulus to the headwinds as the Fed begins to hike interest rates and take back a lot of the stimulus that's been such a positive to the markets here over the course of the last 6 to 9 months. So that's our outlook for 2010, and I think we'll continue these gains here as we've seen since the low. Probably slow that pace a little bit here as we head into 2010, but some additional gains I think are in store. It's really in the second half of 2010 that volatility is likely to come back. We may see a pullback in the market. So unfortunately, it still requires a very vigilant approach to investing, and I think that we're well prepared to adapt to that challenge. I think just having gone through this decade, we've seen the impact of the tremendous swings in the market and the value added an active approach to investing can provide. So I want to thank you all for your time and your attention, and Sandeep for the opportunity to share some of these thoughts with you today. Thanks again.